Our speaker for our first session today is Lori Kaplan. I've worked with Lori for a long time. I think actually Mark Blumenthal was the first person to introduce me to Lori when he was back with the Chamber of Commerce for Buffalo Grove, if I'm not mistaken. And Lori has demonstrated her value a number of times. She's very knowledgeable, and she's been monitoring what's been going on with the changes in the tax bill. She's been looking at the House version that passed, and then more recently the Senate version that passed. The National Association of Realtors came out with a position on this that suggested that they're very concerned about the alteration of the deductibility of state and local taxation, very concerned about the reduction of the cap on mortgage interest deduction, very concerned about extending the time period required for being able to exclude capital gains from 5 of the previous 8 years, where currently it's 2 of the previous 5 years. And their estimate was that it's going to have more than 10% downward effect on the housing market going forward. Now, there are different aspects of this in the different versions, in the House version and in the Senate version, and that's why we have Lori here today. So I'd like to ask Lori to come up and give us her thoughts on what's going on in this world. Lori Kaplan is with Michael Silver, CPA.
Okay, see if this is working. There we go. Thank you, Ralph. And thank you for inviting me to speak and give a tax update to this group again. I appreciate that. So, in the spirit of this being a holiday party, brought a little present for everybody, which is a copy of our year-end tax planning checklist, which hopefully you'll find useful and for doing your personal tax planning. So I've already talked with a few of you today about what is going on in Washington and what is that going to mean for this group as realtors and, as business owners yourselves. So we know now that a bill has passed both the House and the Senate, and they're actually hoping to have this reconciled and something presented to the president by Christmas. Will it happen? I don't know, but we weren't so convinced that the bill would pass the Senate. Got by just a small margin in the wee hours of the night. And what we found happened is to keep things kind of balanced enough to keep it in this reconciliation process. A lot of what was first proposed by the Senate got stricken out and changed. Some things they were going to do, they couldn't because of the cost involved. So as Ralph mentioned, there are a lot of there's a lot of areas where they actually do agree, both bills, and then there's a lot of areas where they have very different approaches. One of those being how they treat pass-through income, which we'll touch on later. So I know this is a very hot topic with a lot of people. I love to be more interactive rather than talk at you for 45 minutes. So please, if you have any questions or comments as we're going along, feel free to jump in. So, basically we're starting with, what's really happening here? They're saying that we're cutting taxes for the, majority of taxpayers. Is that really true? And from what we've seen, we think, technically they are cutting the tax rate for a majority of taxpayers by changing the brackets, at least like in the House bill. But what's really happening is the effective rate is going to be going up for a lot of taxpayers because they are also removing a lot of deductions that we're used to having. And, as is typical for Washington, they're really not thinking through what's the tax consequences of some of these items. The handful of items Ralph mentioned are all ones that are going to have a negative impact on the real estate industry, and I don't think anybody outside, in Washington's really thought about that and what this means. So what are some of those items that we're talking about? Let's talk about them in a little more detail. So the real estate tax deduction right now, that was initially put in to help spur people to want to invest in property and buy homes. They're talking about limiting the itemized deduction, and this is identical at this point in both the House and the Senate versions, and limiting it to $10,000. So for a lot of people, especially in higher cities like Chicago area, a lot of us have taxes over $10,000, which will now be limited. But even for the people that are under that limit, if the government is raising our standard deduction, there's people who right now itemize and take a real estate tax deduction that won't need to itemize this if the bill goes through as they're talking about. And if that's the case, they're again not incentivized to want to have that property because they won't get that deduction. If they're taking the standard deduction, not itemizing, doesn't really matter if they're rent or own. So that's one of the areas. Another thing is mortgage interest. So right now, if you have more than $1 million of original home equity debt, that's also limited. But they're talking, and the Senate bill would not mess with this, but the House bill is proposing limiting that to $500,000, and that's already actually effective back to, it was a date in November when they started dealing with this legislation. And if that's the case, so let's say somebody has an $800,000 mortgage right now, mortgage balance, and they go to refinance now, they will lose their grandfathered status and it will be treated as a new loan, and they'd be limited to the $500,000 if the House version wins in this case. So again, you're taking away some of that incentive, especially for the higher property, higher valued property, which already have been hit hard, haven't fully recovered from the last go round, the recession. So now you're saying, okay, I have a house that is worth X number of dollars, but now you're telling me I don't get any tax break for these real estate deductions, or it's going to be limited, and I might not get to deduct all the interest. It's going to disincentivize people from buying these properties. Another negative factor is, as Ralph mentioned, so in the past, if you owned a property, was your personal residence for 2 out of the last 5 years, you could exclude up to $500,000 if you're married, filing joint, or $250,000 for an individual of the gain that you realized on that home. They're talking now about making it 5 out of the last 8 years, and you'd only be able to use this exclusion once every 5 years. So again, if you have a lot of our country are transplants, they're people moving from different jobs, or that's going to be, again, a disincentive to want to buy in those situations. Or I was even thinking about, what about a startup? Somebody who's buying a starter home. They want to be in for a couple years. If they make money on it, instead of building up that equity, they're going to lose a lot of that equity to taxes. So again, another negative for the homeowners. And this is a lot of why I believe the Association of Realtors is predicting a 10% decrease in the value of homes, because these are all unfavorable developments for the property owner. So home equity loans are also something that, in this case, the House bill is eliminating. So they would they'd allow, again, they're trying to limit your deductions for your original mortgage and eliminate the home equity and for second properties. One thing to keep in mind, though, I know we've had the question, does this affect your rental properties or or business properties and that? No. As long as the real estate taxes are deducted on a Schedule C or a Schedule E or in a business, the deduction is not limited. This is strictly for your Schedule A for individuals. So another area, I know when I was here a few years ago, we were worried then about like-kind exchanges. Would those go away and be eliminated? They have maintained them for real property, which is good news. The bad news from the business owner standpoint is they've disallowed it for personal property. So if you have a car, you want to trade in your business vehicle. If you have a gain in that vehicle, you're now going to have to recognize it. There's no deferring that down the road. And with the larger expensing deductions, where once upon a time pretty much always had a loss on a vehicle, now that isn't always the case. And I'm not quite sure why this was addressed in the House bill, because it's not something we see that often, but they've eliminated the deduction for personal casualty losses. So if you get hurt by a casualty, now they're going to hit you twice. So, but that was not, the Senate bill is also limiting this to federal disaster areas only. So another fun development. As far as on the business side of things, they're also hitting the entertainment deduction. So, meals probably are still going to be allowed at the 50%. There's been some talk about maybe tweaking with that, but you take your clients out for entertainment purposes, take them to sports game, whatever, that's going to be no longer deductible under their proposals. And I know that a lot of people here also deal with the state taxes that they're actually talking about doubling the exemption for. So we'll see a lot less people affected by that, even though it's already a somewhat limited group. They were talking, the House bill would like to repeal the estate tax eventually. The Senate bill does not do that. And some of this is because in the differences in the bills, they each have their main goal is to try to stimulate the economy by having a tax cut for big business. They want to keep big business in the states. That's the main goal. And the problem is that to do this budget reconciliation process and avoid having to get Democratic votes, they had to keep the cost of this within certain limits. So to do that, how do you pay for this? A lot of this is coming from the individual taxpayers, who a lot of them will see their taxes go up once this is passed. One of the areas that could be a win for some middle-income taxpayers is how they're going to tax pass-through income. So we know this for the C Corps, they're talking about having a flat 20% tax rate. For other businesses who are, and they define flow-through as sole proprietors on Schedule Cs. It can be an S corporation, it could be a partnership. But what they're trying to do, and very, very, very different proposals under the two bills. So what the House is proposing is taking what they're calling like part of the income would be like a return on investment. So their default would be 30% would be considered of your income would be a return on investment and taxed at a rate of 25%, highest rate. The rest would be taxed at your ordinary income rates. And they're excluding those of us in the room. They're excluding accountants, attorneys, consultants, anyone with basically personal service income under the argument that you don't usually have much of a capital invested in those types of businesses for a return. If you can prove you do, in some cases you might be able to get a little bit of your income taxed at a lower rate, but generally figure that's not going to happen. On the Senate version, what they're doing, and this will be a lot simpler to administer, is they're doing like a 23% deduction up front. So you take your income, you're going to get 23% that won't be taxed, and then the rest of it would just be taxed at the ordinary income rates. Personal service businesses, such as attorneys, under that bill, would not be, it's an all or nothing. If you're under 500,000, married, 250, single, you would still get to take that deduction, that 23% deduction. If you hit over the limits, you get nothing, no break. It would all be taxed at ordinary income rates. What we haven't seen is how exactly they would apply that. And again, the devil's in the details. And a lot of these changes were done late night, 2 in the morning. So I think out of all the areas, this is where we see the most divergence between the two bills. I mean, this is pretty extreme. So we honestly, I had a client today call and say, so what are you recommending as far as, business structure for your clients? And, I had to say, we don't know yet. First, we have to see what the bill looks like when it passes, because it is so different. And then we can sit there and look at our clients and say, does their structure still make sense for what they, their situation? Yes?
Before you go on to the next, so under the current bill, how is the pass-through income? Under the current bill, how is the pass-through income taxed?
So currently, pass-through income is just taxed at your ordinary income rates. There's no reduction in taxes for it being business income or not. So that's what they're talking about, trying to give a little bit of that break back to the smaller business owners. Now, there's one other part they've kind of snuck in, is that, I believe it was a House bill, but one of them was talking about, so let's say, like right now, if you have a loss from your business, it's been a bad year, you're active in your business, and let's say you have a $200,000 loss, you can take that against your other types of income, against wage income, maybe of your spouse, dividends and interest, et cetera. They're actually talking about maybe eliminating that and saying, and again, this it has to be the Senate bill because it's the 500, 250 thresholds. But if you're over those thresholds, saying no, then you're not going to be able to offset that against other types of income. It would just go in a net operating loss, which you would carry forward. That could be pretty huge. You know, if your business is hurting, you need that break now, not down the road. And again, don't know if that one will come to pass or not, but it's in it's in the Senate version. So, you know, aside from other deductions, you know, charitable they're keeping, that they haven't touched. Interestingly enough, so when they started this whole process, back when they were first talking about it, and were looking for a way to pay for this, they were looking to maybe do something with the retirement income, kind of cap what people are allowed to do. They were talking about like inherited IRAs being taxable over 5 years and, you know, making you pull it into income. And there was so much pushback from the retirement industry that they basically changed those plans, and we're not seeing any of that in the final versions, you know, that passed the House and Senate. So now we've got, you know, groups such as yours that are unhappy about and trying to protest what's going on, aspects of the bill. You've got states that are trying to protest the bill. So one of the other deductions they're tampering with, aside from real estate deductions, is they want to get rid of the state and local income tax deduction. And that's there in both bills, the way they stand now. So you have Illinois just raised their income tax rate, and now you're not even going to get a benefit from it. You know, that kind of stinks. So, you know, the high income states are protesting this as well. You know, Illinois, California, you got New York, they all have high tax rates, and you know, also those are going to be ones that probably will have the higher real estate tax rates as well because of the types of property and they have. So, you know, Illinois, we've got all the political issues that are driving a lot of people to want to leave the state. Now you're going to lose potentially the tax break, and you have higher income taxes. So it's just not a good place to be right now. Yes?
Effective dates. Is each of these, I'm sorry, is each version going to have a separate date that has to be worked out in reconciliation? And are there piecemeal effective dates, or is the entire legislation going to have one?
Okay, that's a good question. So in the House bill, most of the provisions would kick in starting with 2018. For the Senate version, a lot of those are starting with the 2019 tax year, some in 18, some in 19. You asked about rates, and it's interesting too, because the House bill would actually keep the same highest tax rate, but just change the brackets. So they have less brackets. For example, they take the 10% and the 15% bracket and change it to a 12% bracket. And they'd have, and you might get that bracket through a little bit higher income levels. So they are keeping their promise of reducing tax rates. But again, the effective tax rate is really a function of your individual tax situation. What deductions are you losing? How much of that are you gaining, from the lower brackets? And the Senate is keeping their rates are dropping a little bit. Mostly, I'd say like about 1% at the different levels. They've got multiple brackets, but I just looked at. I remember I looked at it for one of my clients that was in about $100,000, $120,000 worth of income. And when I looked at the effective tax rate for that particular individual, it was going to be pretty close under any of the versions where they were going to end up with their taxes. In their case, that's going to be very different depending on the personal tax situation. So yes.
There was talk about incentivizing corporations that have trillions of dollars overseas to bring that money back in. Is that addressed at all?
Yes, that's, and again, the rates are different. They're trying to give them, they're going to tax them on the way in, but they're trying to make it a lower rate to make them want to bring it in now instead of later. I mean, there's actually a lot of foreign provisions that are hidden in the tax law. I didn't really pick up on them so much for this presentation, but it's definitely there.
Certainly doesn't affect me.
Yeah, there's also a lot of tax credits that some of the corporations will lose, and that's part of the price for getting the lower tax rate. So it's a question there.
The standard deduction, is it the same under both plans? And if so, what is it?
It's around $22,000 that it's going to. It wasn't identical, but it was very close between the two.
So $22,000 what, for married filing jointly?
Right. So it's roughly double what it is now, but then you lose the exemptions.
The exemptions or the itemized deductions?
So the itemized deduction, well, standard deduction is doubling, and they're taking away the exemptions. So if you look at your overall break, it's, you come out a little ahead,
Yeah.
dollar-wise, but not,
So we'll lose the exemptions, and if you don't have real estate taxes and home interest above 22,000, you'll just be, what? Here's what I earn, take the 22 and by the tax rate, times the tax rate.
yeah, more or less, yeah.
So here's what I earn, give it to me.
That's their quote-unquote simplification, but it's really not so simple, so straightforward. I think they're saying it's simplifying because so many more people won't need to itemize anymore, but that doesn't necessarily mean it's a good thing. Simplification can come with a cost, and maybe I'd get down under that level, but it's only because I'm losing so many deductions in a lot of cases. Because you think, if you think about it, when did you start itemizing on your tax return? For a lot of us, it was when we first bought our house. And we had real estate taxes, we had mortgage interest. If you don't own property, maybe you itemize because your income is very high and you pay a lot in state and local income taxes. Without those deductions, it'll be simpler, but you're probably going to, most likely those people are going to pay more in tax, depending, again, what else is going on in their returns. So it's, the other interesting thing is one of the platforms, I believe, that the Republicans had talked about was they wanted to eliminate the alternative minimum tax. And for those of you who aren't that familiar, so basically, most of us are familiar with our regular tax calculation. You see it on page, the first couple pages of your tax return, and it's pretty straightforward. What most people don't see, and it kind of happens a little bit behind the scenes in your tax program, is the alternative minimum tax, which basically recalculates your income using a different system. And in that calculation, and it looks at the two calculations, and if the alternative minimum tax is less than the regular tax, it doesn't affect you and you don't have to worry about it. If it does, then you pay an additional amount. That the difference is called the alternative minimum tax. And in that calculation, if you have an NOL, it's limited to 90% of your AMT income. It adds back your taxes, state and local and income taxes. It adds back your real estate taxes. It adds back a lot of itemized deductions, some of which they're talking about eliminating under the different plans. So in some ways, what I kind of see is they may eliminate the AMT, but they're pulling in a lot of the AMT provisions into the regular tax now by eliminating a lot of these deductions. And interestingly enough, originally, both the House version and the Senate version did repeal the individual AMT tax. And what happened is in the late hours in the Senate, they basically reversed that. I'm good for now, thanks, Ralph. And they said, we can't afford this now, we're not going to repeal it, but they agreed to increase the deduction by about a third, about 35% over what the AMT exemption is now. But if you think about it, now that we're making all these adjustments to the regular tax, my gut feel is that a lot less people will be subject to this anyway, just because the two taxes, you're increasing your taxes here and this is staying about the same, some people will fall out of AMT, I think, anyway. Yes, question there.
In relation to the 2 out of 5, 5 out of 8, correct me if I'm wrong, but at the moment, if you don't make the 2 years, if you've owned your house a year and a half and you sell, isn't it, they take a percentage of how long you've been there for the 2 years and they apply that percentage to the 250 or the 500, so you're still able to have tax-free money, but only at that percentage, right?
I think that's in certain situations.
It's at least a year. I think there's a private letter ruling that addresses the possibility.
Right, and I don't know if that will be factored in under the new law or not.
So you said that 1 out of 5, so you don't know if they're gonna, it's a flat, no doubt, if you don't make it 5, you just don't get anything. If you make it 4 out of 5, you don't get 85% of your
We don't know. Again, that, you know, we've seen the broad picture of these, of what they're proposing, and what, you know, the details typically get filled in after the fact. And so we don't know what that'll, if they'll have some sort of proration or not. Guess is as good as mine, but it certainly won't be as friendly. And, you know, the other thing is, again, for higher income taxpayers, there's potential that they'll have a phase out of this as well. So if you're over their income limits and you have a gain, even if you meet the 5 out of 8 years, you may or may not be able to actually benefit from this provision. I mean, they're definitely tightening the screws. So, you know, so we're talking about some of the itemized deductions. A few other things that are on the table are, you know, so medical expenses, which will hit a lot of our, you know, hits a lot of our elderly. And, you know, we're just starting with 2017, the threshold went to 10% of your AGI. So you have to be over that to actually be able to take a deduction. But, you know, for people in nursing, in skilled care type nursing homes or assisted living, a lot of times they do have a significant amount there. Or dental work, that's another huge hit. And under the House bill, they would repeal that deduction for medical expenses. Under the Senate version, ironically, they're talking about lowering the threshold back to the 7.5% that we were used to for so many years. So again, these are some of the dichotomies between the two versions that we don't know how that's gonna, what the ultimate outcome will be. And in the terms of the miscellaneous itemized deductions, there's been talk under eliminating accounting fees under both, which of course we're not happy about. They're talking about investment fees potentially being disallowed, employee business expenses, which right now flow into the 2% itemized. There's talk that those may go away. And investment advisory fees, which is another common deduction under within the 2% itemized. That's also being, and again, differing between the two versions. We don't know what will ultimately survive in, you know, that arena. So, you know, we've talked a lot about various pieces of bad news. You know, so what are some of the things that we're talking about with our clients, trying to do some year-end planning? And, you know, some of it is, and you know, I caution that it's anything I say now, you gotta talk to your own accountant and or tax advisor, because it's very specific to everybody's individual situation. You know, for example, if you're an alternative minimum tax anyway, paying additional taxes won't help you. You know, won't change your tax bill at all, and you just have to pay, you know, part with the money sooner. But for people who aren't in the AMT or have some room to play with, you know, in some cases we're suggesting, you know, paying early on your state taxes. Definitely, if you're going to owe an estimate come January and you can benefit from it, consider paying it early in December. Another thing, so with the Illinois increase, tax rate went from 3.75% to 4.95% last year. To be penalty proof, which is how I know we normally set up our estimates for our clients, you just have to pay in what you paid in last year. But if they can benefit, so if you know you can get a tax break this year, if you pay your taxes early, and we don't know if you'll have one next year, there's a good chance you won't, it might make sense to do a quick calc and say, what do I think I actually will owe on my Illinois taxes for 2017, and whatever the difference is that you haven't already paid this year, pay in now. Again, you know, depending on if you can benefit from that or not. Mm-hmm.
Practical application of that. My understanding that if you sell your house and you're the seller and you give a tax proration, that those are taxes paid this year and you get to deduct them.
Absolutely,
correct?
yeah.
So if you're going to close on January 5th versus December 31st, you better move the closing date up. Is that the idea?
All things being equal, and if you can, it might, if it makes sense for you.
Yeah. Thanks.
Lori, in response to, I think it was Steve Bick here, on the exclusion, it appears from the current publication there's 3 reasons that you could exclude even if you didn't meet 2 out of the 5. One is health-related, one is business-related move, and the other is unforeseeable circumstances. So
Okay.
under most normal circumstances, someone's not going to be able to just say, I get a 3/4 exemption.
Right. Thanks, Mark. We have a question in the back there.
This is more of a procedural question. I probably should know the answer, but let's say they do come to an agreement, the House and the Senate. Does it go back to both houses for a vote, or does it become law when the president signs it?
I believe it, I'm actually not positive on that. I think, but I mean, I think they both houses have to pass it first, and then it doesn't become law until the president actually signs it. Because believe it or not, someone actually asked that question.
So then it would go back to the House and Senate for their approval.
Because they have to approve the final version, because it's different than what they originally had.
Yes. So there's a second.
Right, and some of the thinking is, you have the two versions of the bill, and the Senate version, I believe, passed by one vote. It was very, very thin margin of passage. The House version passed with a little more leeway. So there's some thought out there that maybe it'll look more like the Senate version because they can't afford to lose any of the votes in the Senate. So that's just something I've heard. When it comes down to it, I don't know, because again, the House version, where it's different from the Senate, if they suddenly change the provisions, who are they going to lose? What votes will they do?
Do you know, is there any provision change allowing IRA contributions? Or, in other words, if I want to use my minimum RMD to make a charitable contribution, I can make it direct to the charity, and then they get the 100% of the RMD.
Correct. That was made permanent, as permanent as anything is in tax.
Right.
In the last go-round, and I have not seen anything that would change it in the current.
Okay, thank you.
The only thing they've talked about that I've seen with charitable is actually maybe increasing the AGI limit from 50% of your AGI to 60. So that would actually be more of a benefit. Another little more obscure thing, and this again is not consistent with the two bills, but I believe it's the Senate one that's saying, so right now, if you sell a security, you have an investment account, you can tell your broker which of your lots you want them to sell. If let's say you have 3 different lots with, you bought 5 years apart, and you don't want to sell the oldest lot because you have lower basis there. You want to sell the most recent one, which has very little gain, and you can specify that. In one of the provisions that's out there now, they're saying, no, we're going to make everybody do that on a FIFO basis, first in, first out, which would force you to go back to the oldest securities and pick up more gain, when you go to sell them. So if, one of the strategies out there right now is if you have that kind of situation, you might want to think about, and you're thinking of selling soon anyway, you might want to sell now when you can pick which lot you sell rather than later. But if you're not thinking of selling it soon, it doesn't make sense just, to avoid a little bit. If you're going to pay the tax today, it's probably not worth it, unless it's a short-term timing difference. But the other strategy is right now, going back on the charitable comment, and yes, you can give the gifts of your IRA, RMD directly to charity. You can also gift appreciated stock to charity. And if you do that, you still get the deduction for the fair market value of what you've contributed to the charity. They sell it. They're not for profit. They don't pay any gain on on the difference. So that's one strategy if you're charitable anyway and you want to avoid paying tax on a low basis stock. And that still should be valid even under the new law. So, any other questions? I know I talk fast, so wanted to get everything in. I've got one there.
With the changes to the estate tax area, what about stepped-up basis?
That was, so in the repeal, the House was talking about having the stepped-up basis. The Senate doesn't address that, so we're not sure. It's possible that you would lose that under their version, but they also didn't repeal it. So at one point they talked about a later repeal in the Senate version. I think like 2026 or something, and then they had not addressed the idea of a stepped-up basis, but now they eliminated the repeal in the final version that came out. I think that's what you're referring to.
Yes, thank you.
It's not even being phased out over time, it's just off the table now. There won't be any action on the death tax at all.
Again, in the House version, they still have to reconcile, yeah, the Senate version, no. The House version, since they still show a repeal, it still could happen, but we don't know. And
Come back and say, everybody gets 10 million, or something like that. They could just not repeal it, but just maybe have less people over.
well, that's where they're at now. They're talking about doubling it, so it would be, double what the
To 11
assumption is
million
now.
for an
Yeah.
individual, 22 for a married family jointly.
But, one thing to think about though too, because we do a lot of estate tax work, like in my firm, and you may not have an estate for federal purposes, or some people are filing for portability, but you still have an Illinois death tax that kicks in at $4 million. A lot of states did repeal the state portion of the, estate and inheritance taxes back when, the federal changed and they got rid of the state tax credit, but not all of them did. I mean, Massachusetts still has an estate tax and that kicks in at a lower level, and some of the other states, do. And again, it's not, they're all at various levels, so state planning is still, warranted. And without the federal, consideration in there, the state taxes can get pretty expensive.
And as we all know, that the Illinois Department of Revenue can be more difficult to deal with than the IRS, so you have to carefully plan these things. I wanted to ask a question, if I may.
Mm-hmm.
As I recall, you had these holdouts in the Senate, and deals had to be struck with, the holdouts were McCain and Murkowski and Collins. And then McCain came around, but then Ron Johnson wanted a piece. Lisa Murkowski wanted something with Anwar and Alaska. Collins wanted something with Obamacare. Do you think that those wheeling and dealing promises are going to withstand this reconciliation? Do you think they're going to stay where they are?
I honestly don't know, because, when they first, once they start with the reconciliation process and they have this provision that they change, that'll either increase the projected deficit or lower it, and if that increases, then they've got to tweak something else over here. So I think it's going to be, it's like doing a puzzle. You shift this piece here, now everything over here shifts. So I don't, that's why none of us really know for sure. And even maybe where the areas where they agree on may have to be changed to make things work. So.
There's also a possibility that some of the people that voted for, especially on the Senate side, to pass it by a simple majority,
Right.
knew in advance that it would have to go to reconciliation, and when it comes back, they may change their vote, knowing full well that when they voted for it in the first place, it was going to have to go to reconciliation. So there's also the game that, okay, I'll vote for it, but not that I'm going to vote for it when it comes back out of reconciliation, but I'll do my part and send it to committee, and then wait till it comes back before I change my vote.
No, that's a good point. And I know that, from what we heard, they were definitely strong-arming the senators to pass the bill. With the Affordable Care Act debacle, that the Senate could not get it repealed, the Republicans couldn't get that repealed, there was a lot of pressure on the senators to make this bill pass. I mean, because they really needed to save political face, and that was a big part of it. And, obviously I wasn't there, but, what I was hearing from the media myself was that they were basically telling them, don't worry about, kind of like what happened with ACA years ago. Don't worry about reading it, or the details, just pass it and we'll figure it out later. So that gets back to your concern that, a lot of them, I don't think were quite sure what they were passing. And when they get in the details, and their constituents or groups such as, the real estate organizations start fighting some of these provisions, they could change their vote. Or things could shift in terms of how the final bill looks. So, just out of curiosity, they're saying this would be the most massive overhaul since the 1986 Tax Act, so that's pretty big. Yeah.
Is there a deadline for reconciliation? Because it seems like that some of the things we're talking about may not take place, and there may be things we don't know about which may be effective that we have no way to plan for.
That is true, but not unprecedented. I believe the last time I spoke here, we were talking in December about what was going to be effect for that year. Not even the following year, but that year it just happened. So it's, a lot of the legislation can become effective, once it's on the table. And sometimes they do go back retroactively to the beginning of that year when they first put it out. So even if this went into next year, it doesn't preclude them from making those changes back to January 1st of 2018.
Is there anything proposed to extend the Debt Forgiveness Act?
No, that went away a while ago, so that wasn't even talked about, because that was already off the table in 2017.
Right, it expired at the end of 16.
Correct. And
So
that,
nothing about bringing it back, extending it further?
no, it's not even been discussed. You know, the one thing I'll say there, I know that was a very popular provision in this room, you know, is still keep in mind there are some options for excluding income using Section 108 of the tax code, which is if you're insolvent or, you know, in bankruptcy proceedings. So that does help some taxpayers. You know, but obviously they would need to consult a tax professional on that to see if it would help their situation.
Quite some time ago, when I first got into mortgage foreclosure defense work, one of our colleagues recommended that you phrase any negotiation on the reduction of the debt as a settlement, because at the time settlements were treated differently than income on forgiven debt. And he suggested that if you by simply objecting to the foreclosure and setting up a defense, that you could then, if there was any subsequent reduction in debt, you could categorize that as a settlement, and it would have its own deductibility compared to forgiveness of debt.
I have to be honest, you got me on that one. Not quite familiar with how that would work.
Well, the problem that we had was all this forgiveness was treated as phantom income, and you get the 1091 issued or whatever, and people didn't know what to do with that. And so if they were advised that if you could characterize it as a settlement and avoid the phantom income problem, maybe they would be a little bit better off. I haven't looked at that lately, and I don't know what's been the latest discussion on that.
Yeah, that's nothing I've heard really talked about ever. It's nothing I personally have looked at. It is definitely creative. You know, I think as Ralph said, the biggest problem was a lot of times when there'd be a forgiveness of debt, a lot of the people wouldn't even know it was coming. Or we've seen tax returns. Somebody has come to us because they got an IRS notice from a couple years back because they never picked up this income. And on top of it, if you had a husband and wife who divorced after, or subsequently or were divorced in that year, if they were both on the listed on the property, a lot of times the banks would issue 1099-Cs to both of them. So then they'd be, doubly screwed because had to argue that with the IRS once. It doesn't make sense. It's not fair to you don't get to benefit by taxing something twice. It should be one or the other, not both. And but if they had a form, they would try to tax it. So it's a tricky area. I mean, I just want to point out there are still things you can do, but it is not. They did get rid of the main act, unfortunately, so.
Other questions?
Okay. I will let you know. Ralph was kind enough to invite me to stick around for your party after, so if anything comes up or you think of anything else, I'll be happy to take questions then as well.
Okay.
Thank you.